This is Chris McAfee, Head of National Sales here at BX Partners. Today, we're talking with Charles Helm, Managing Director and Portfolio Manager at BH Asset Management. Here to talk about Charles's international strategy, which has had a really impressive results over time, delivering performance in excess of the EFA index, which is the typical benchmark for international, with lower drawdowns and a much lower beta than the index itself. So, Charles, let's get into the strategy and what drives it. Tell me a little bit about your overall approach.
Well, we buy global leaders, Chris, that dominate their market position, either number one or number two. So it's not a disruptor strategy. Outside the U.S., ROEs are half or lower than the U.S., and that means finding growth is tough. So it's important to find companies with rising sales, high cash flow generation, especially since the banks are not lending overseas given negative interest rates. Those kinds of companies need to be adept capital allocators. That is, they have to know where their margins are going to be and really focus their business on those lines that are going to be most profitable. So when you think about the world and where growth is, you probably don't think about the UK or Europe as being big growers, and you certainly wouldn't think of Japan as a big grower, but we find opportunities all over the world. And if you look at just the UK, for instance, consumer confidence and April retail sales are roughly double what they've been expected to be over the last year, and the economy's booming even with Brexit. In Europe, the flash PMIs look good. We saw U.S. service sector this morning up 70 versus 64. We think Europe's going to follow 6 to 8 months in the U.S. path, as it traditionally has. And we have some very good indicators that that's happening right now, with Santander, for instance, tripling their revenues in their payments business, with the other European banks announcing lower reserves and releases, better than expected asset performance, and generally seeing higher revenues and earnings despite that negative interest rate environment, and much bigger lockdowns, lower COVID vaccine rollouts, and generally tougher cross-border transaction and supply chain problems with employees with high absentee rates and callbacks to factories, trailing the U.S. considerably. The Far East, you could say the same thing. It's still hampered by COVID resurgence, with Taiwan, South Korea, and Japan held back, especially in service sectors. In addition, you've got East-West tensions that continue, with Chinese delistings, the EU formally freezing their deal with China, and even today's illegal incursion by U.S. warship in the South China Sea, according to China. So Japan Q1 GDP likely contracted. There are some pockets of strengths, for instance, in Taiwan, which benefits from their huge chip manufacturing and foundry business. and that favors many of the South Korean chip manufacturers too, like SK Hynix and Samsung. So so go ahead.
What I wanted to get into next was, so are your forecasts for interest rates, currencies, policies driving your regional and country allocations, or is it more of a bottom-up thing that leads you to the makeup of the geographic diversity of the portfolio?
So we definitely view the world as global, and that means I can buy Samsung, or I could buy Apple, or I could buy Siemens, or I could buy GE. It's really a global world, and those multinational companies are operating in direct competition. So the country barriers are not really a factor. Most of them are global exporters, and they are global champions. So in the UK, some of the top exporters are and have been the pharma companies, whether it's AstraZeneca or Glaxo, and they have more than 60 or 70% of their earnings and profits outside of the UK, similar to a company like in the US like Coca-Cola, which has 65 to 70% of their revenues and profits outside the US. While that's the case, we do consider only those companies with headquarters outside the US for our international portfolio. And that means that having knowledge of those companies and their operations is very important. Often those companies, though, like US global multinationals, have significant operations in the US and in other countries. So knowing the operating environments for those companies, knowing the operating environments for their major customers, and knowing the factors that are affecting their businesses are critical for determining our industry and sector exposures. We do look at currencies, and obviously with a weaker dollar, there's a significant tailwind for companies that are generating cash flows in other currencies to improve our returns. Sorry, I lost you.
That's it. So there's been a big rotation globally, really, just very recently from growth to value. Has that impacted your portfolio and its returns?
Well, we think more in terms of duration of assets. So if you have a very low profitability but fast growing company, that's sort of a long duration asset, and if you, or a growth company, and if you have a company that's in more traditional industrial or materials business where the cash flows are high, they have high fixed costs, and cyclical recovery benefits them with a tremendous burst of cash flow and profitability, that's more of a sort of a low duration asset. So as rates rise and we look at inflation, those low duration assets are more favored in the marketplace. That's benefiting our portfolio because of our industrials exposure, our high cash flow generation focus, and we do have some cyclical exposures, not in transportation, but in industrials and those companies that are serving auto businesses, for instance. So we sort of go middle of the road between high growth and sustainable growth businesses. And we found that through a cycle, we're able to outperform that way. There are sectors that we don't own just because of valuation and because of lack of visibility on catalysts. Those include real estate, and we don't own utilities. So those are big components of the index that we don't have exposure to.
So Charles, there's a lot going on in the world right now, both positive and negative. Where do you see big risks or big opportunities that people aren't necessarily thinking about right now?
Well, I think everybody's thinking about risk right now, and that was maybe not the case in February when everyone was buying beta. So it's the implosion of the SPACs business, the recent decline in speculative areas of the market like coin, and some of the really high multiple internet businesses that were favored during COVID have started dropping down to earth. We don't own those businesses, but we do own what we think is the future for profitability, and those are a lot of chip companies, cloud computing, 5G, and industrial beneficiaries, as well as media. So our second biggest position in Japan is Sony, and our largest position is Hitachi. But those are global businesses, and they're exporters. In terms of risks, we think there's a big risk to companies that don't have sustainable business models that are trading at high multiples, such as some materials companies. So we avoid things like rare earth companies where others might find some opportunity. Other areas that we find very interesting right now are in financials, because they're one of the few sectors that will benefit tremendously from inflation as interest rates go positive, as the yield curve provides higher net interest margins, and during the global recovery as loan volume increases, as reserves are reduced and released, and as those balance sheets and revenues pick up and improve, they're some of the most discounted assets in the world. So that's where we're trying to get exposure.
That's great. So just to close, I think that what many advisors are looking for their clients is a manager that has a consistent and repeatable process for delivering the return stream that they're looking for. How would you, in a nutshell, define your consistent, repeatable process?
Well, we haven't changed it since inception. We stick, as I said, with those dominant market position companies, number one or two. The companies have a high intrinsic value relative to the market price. Management's interests are typically aligned, although we all know outside the US, managements are not particularly compensated with stock. We do look for a higher return on equity than the average company. We want accelerating sales, but high operating cash flow generation is extremely important, low long-term debt to equity. And the portfolio has always had those types of characteristics.
That's great, and those are kind of timeless, timeless characteristics to have within your portfolio. If you'd like to learn any more about the BH Asset Management International strategy, please get in touch with me, and we can arrange a follow-up conversation and get you the materials that you're looking for. Thanks, everybody. Have a great day.